Hi, it's Toby here from Track Capital Investments. I'm here today to give you my view on what the post-coronavirus property market could look like, and also take a look at what is currently going on in the property market at this moment in time. If you don't know much about us here at Track Capital, we are an innovative property investment company. We source and deliver exceptional investment opportunities across the UK to our global client base of investors. We help investors start and grow portfolios. So that's enough about us. Let's go into the current circumstances of the market that we find ourselves in due to this global pandemic, which is COVID-19. So, how has the coronavirus affected the UK market? If we take a look at Zoopla, which is one of the #1 property portals here in the UK, their recent data shows that new property sales agreed in the UK has actually fallen by 70% since the start of the coronavirus restrictions. Now, this does obviously make sense with the restrictions in place and lockdown. Nobody can get out and physically view or buy properties. So it would make sense that we've had such a high drop in new property sales agreed. Also, they have seen that the number of people wanting to actually find out more about properties or view them, that started to decline early March, which again, we can see around here, the decline starts. And that's the sales, of course. And we do also see that with the demand for viewing and finding out more about properties, with that starting early March, that were tying with when the media started to really start reporting about the coronavirus. It became very prominent. So people's attentions obviously shifted from stuff like viewing or buying properties to what was going on and looking at how it was progressing. So they stated it drops more than 60% over the month, which again isn't surprising with the circumstances we have found ourselves in. However, there has actually been a rise in people browsing Zoopla and the internet, searching for properties since the beginning of April, which again is a promising sign. People are getting used to the fact of how we are finding ourselves. They're in lockdown, so obviously most people have a bit more time on their hands to be searching the internet. So this makes sense to why it started to pick up. If we take a look at some data from Rightmove, which again is the other prominent property portal here in the UK, they have showed that the average price of property coming onto the market, the price has actually only dipped 0.2%. So that's quite positive. New properties coming on, prices are staying fairly strong, and there's only been a 0.2% dip. Rightmove also shows that in April there was a year-on-year UK house price increase of 2.1%. Again, very positive news. This may change going forward, may change in the short term, but as it stands at the moment, April saw a 2.1% increase. Now, let's take a look at the latest Hometrack report. So this is the Hometrack report from March 2020. Hometrack is actually part of Zoopla. So again, very data driven, some great data and some great information. Here at Track Capital, we always look through their reports and go through them on a monthly basis. Some great bits of information that you can find there, and some great insight into the market. So in the latest report, we can see that there's 373,000 property transactions that are on hold during the coronavirus lockdown at the moment. That's a combined estimated value of £82 billion. This, to put it into context, for estate agents is £1 billion worth of sales revenue for them. So estate agencies, letting agencies have been hit hard obviously by the coronavirus, but estate agencies side has definitely been hit hard, very, very hard. So they are definitely wanting the market to pick back up and get going again. This report also said that demand for homes fell by 70%. as we saw previously. The decline actually bottomed out by early April, and then, like we saw previously, there's been an increase in demand, and that's been over the 3 weeks up until the 19th of April. Agents, although they're taking on lower levels of new supply, the number of homes for sale is only 4% lower than that at the start of March. So this tells us that there hasn't been a massive mass withdrawal by sellers in the market. So vendors didn't just pull their properties from the market. They are staying on there. They are hopeful that they can still sell. So very positive outlook there from the sellers. We can see in the report that cities in the north of England have recorded below average falls in demand over the recent downturn, and they've also recorded some of the stronger increases in demand over the recent weeks. Notably, Manchester, Liverpool and Leeds, this would be mainly because they're the cities where affordability remains attractive. They actually started 2020 very strongly as well for this reason. So what you will find in those cities is, because the affordability is still attractive, they have a greater pull and demand of buyers. Investors are still looking in these places because the prices are more attractive, the yields are better there as well, and you've also got buyers that are looking for themselves. Again, they will remain active because of the affordability. Whereas you've got the southeast, London, affordability is not as attractive, as you may know. The price to purchase is a lot higher, stamp duty is a lot higher, so they won't be as attractive at this moment in time as they weren't in general anyway. So we can see why places such as Manchester, Liverpool and Leeds have experienced this. So how are other countries performing? So let's take a look at other countries that are slightly ahead of the curve compared to the UK, as this could help give us an indication of what we might have to come. China. So in this data here, it's daily property sales in 30 major cities in China. So what we can see here is, you can see from, obviously this data shows 2017, 18, 19 and 20. You can see that all the years follow suit around here, where there is this drop, and the reason for that drop is that that is Chinese New Year, and everything shuts down, every business shuts down in Chinese New Year, so hence why you have that. So what usually happens is you can see this V shape in all of the other years, where Chinese New Year is over and property sales start to return, and it starts to pick straight back up, and you have this V shape. Now, what happened with coronavirus? We can see that Chinese New Year happened, everything completely stopped, but then as you look at this area here, it completely bottoms out and stays there for a few weeks. So, and then after a few weeks, it starts to then creep back up, and that's where we see the slight incline there, which, although it's not back to the levels it has been previous years, from what we can see here on this graph, you can see after a number of weeks the demand starts to come back in, and what we actually see is a sort of tick shape that it follows, with demand there for the sales in China. So again, a good indication. We could see that this is sort of how the UK could follow suit, and we'll see later on sort of some other data that suggests that we might follow suit with this as well. Now let's look at America. So you can see here, with the coronavirus, as you can see, it takes a massive dip, hits the bottom, bottoms out, and we start to then see a slight increase here. So we see Seattle and East Bay, they are sort of ahead of the curve, and then we've got Austin, Portland there, just slightly behind, and then we've got New York here, which is still bottom out. Now, obviously with America, different states have been affected differently, some more sort of tougher restrictions, some easing out a lot quicker. So this is why there will be sort of differences in the different states here. But what we can see, again, it looks like it's going to be following a similar curve to that of China, and it would look to follow up here as well. So again, positive that it is looking to follow China, which would then hope that we could potentially see the same as there. So demand here showing that it should pick back up. Now, let's look at the UK. So again, from our friends here at Zoopla, this shows the browsing data. So this is the browsing sales data from Zoopla, and we can see here that early March, once the coronavirus news starts to really hit and start taking effect in people's lives, we can see the downfall. And then especially here, 23rd of March, government announces the lockdown. It hits the bottom, bottoms out for a while, very low levels, stays along that bottom, and then we start to see a slight incline. So if we look at this as well, it's potentially looking to start the upward trend of the tick that we have seen in China and America. So again, quite promising. This could change. It all depends what happens in the coming weeks or how long lockdown does go on for. But we've just heard that the government is going to be announcing the measures they're going to take to ease lockdown, which is very positive. So we would hope that this tick sort of form should continue. Right, so what is the media saying? So no doubt you would have seen all the headlines, a lot of doom and gloom, obviously, everything around the coronavirus, and property always gets dragged into these sorts of scenarios, and rightly so. Now, when we look at the media here, we look at the BBC News here, one of the headlines, coronavirus, property sales down 70% since lockdown, says Zoopla. Very alarming headline. We've seen previously when we looked at the Zoopla data, yes, that is correct. However, sales down 70%, well, of course they're going to be. Everything's on hold. People can't physically buy at the moment. People can't view properties. So this would make sense. Yes, and it's alarming. Yes, it is not the best news to hear. But when you look at it on the scale of things, it's justifiably so why that number and that percentage is what it is. Now, let's look at the Sun. So the Sun here, their headline, COVID crash, house prices set to plummet by astonishing 13% by end of 2020 due to coronavirus. Very alarming headline. They have actually, in this article, they've used data and predictions from CEBR. That's the Centre for Economics and Business. They are a think tank. So they've taken the information from them. We are going to come back to them later on because as they've used this information, we will later take a look at CEBR and what they've predicted previously. Then we've got The Guardian here. UK house sales will collapse in 2020 as market goes into deep freeze, says study. Now, again, a very alarming headline, very negative. You look at that, you would think, right, God, it's going to collapse. Let's get out of the property market. Let's not even think about buying or investing at this moment in time. But in sort of when you look here, major analysis of coronavirus impact stresses property prices will dip only 3% and then rebound next year. So although you have the sort of clickbait negative headline, when you read a bit further, it's not actually as bad as they make out. And that's using Knight Frank data. They actually reported that it's going to be a dip of only 3%. And then in 2021, they're actually predicting a 5% increase in the property market. So not as scary as the headline might make out, but if you didn't read any further or look into any more, you would be going around thinking that the property market's going to collapse. You'd be telling your friends and family, and that's how these sort of things spread. So now let's take a look at the media versus reality. So let's take a look at when the media reports such negative headlines. Do they come to fruition? How much truth is in them? What actually happens? So the first one we're going to look at, this one here is from The Guardian. Headline, house prices could fall by 18% if Britain quits EU, says George Osborne. So this is obviously when the Brexit vote was coming. This was something George Osborne had said. He said if we left the EU, that house prices could fall 18%. Very, very negative headline, would have you think if we leave the EAU, the housing market's in big trouble, could potentially sway some people's votes. I know the property industry was definitely looking at this and getting very worried. So what we can look at now is, let's look at what actually happened to the property market. Was George Osborne right? So when we look at the UK property market, this data here is from Land Registry. So this is actually Land Registry data and prices. This covers January 2016, so just before the Brexit vote, all the way up to December 2019, which is when Parliament finally laid down a statute to leave the EU. So what we can see initially here is it hasn't actually decreased, it's increased. So let's take a look at how much it actually increased by. Now let's remember George Osborne was saying it could fall by 18%. So let's see what it actually did. UK house prices increased by 13%. They actually increased. So very, very long way from George Osborne's negative 18% fall in house prices. They actually performed very well. Now, let's take a look at this one. As I mentioned previously, we're going to look at the CBR. So house prices will drop across the UK in 2015, says CEBR. Again, this is The Guardian. So when we look at this subheading, London will see the first marked falls for more than 5 years, with property prices slipping by 3.3%. Again, if you were going into the year 2015 and saw this, you would think, oh, maybe it's not a good time to buy or invest. Price is going to drop. Let's hold out to see what happens. Again, negative headline. They actually, in this article as well, predicted the UK as a whole would drop around 0.6%. So let's take a look again. So again, Land Registry data. January 2015 to January 2016, we look at the year, and here we're looking at London because they said that was being affected the most. And when we look, we can see again an increase. So not in line with what the CBR predicted. Let's have a look at what it actually did. London house prices increased 13.5%, and UK actually increased 7.7%. So again, quite far off what they had predicted. The reason I wanted to show this is because when you read stuff in the news or the media and they're taking predictions or data or whatever it may be from different places, always do your own due diligence. Look at where it's come from. Look at the source. How reliable is it? Because all I had to do was look at previous forecasts from the CBR, and I immediately found this one. So it just gives me the thought that maybe take what they say with a pinch of salt and don't believe it. It obviously is just a prediction. They could be right, they could be wrong. With what I'm predicting or my outlook for the property market, could be right, it could be wrong. But I always say just do some due diligence yourself, just to give yourself that extra bit of information to help you make an informed decision. Now we come on to the 18-year property cycle. Now, I've brought this up just because we use this in the property industry to sort of give us an indication of where we might be in the property cycle. So if you don't know about the 18-year property cycle, look it up. We do have an article about it, which you can find online. So do check it out. There's various information about this. It covers hundreds of years of data of property prices, and it's produced that we have a rough 18-year property cycle. This is how it performs. So if we look at this, a lot of people are thinking we are here. So we're at the top and the property market is about to crash. That is quite a common theme that I'm finding when talking to people. And if you look at the media, they're saying the same, the market's going to crash. Now, when we look at it, myself personally, I have a different perspective. I actually put ourselves around here. So I believe we're in the mid-cycle dip. Now, the reason being for this, if you look at the time frame from the last price crash to now, it kind of does tie in quite well. A lot of people thought in 2016 that Brexit was actually the mid-cycle dip, because when it was announced, again, very negative, property prices are going to be affected. There was a lot of confidence knocked out of the property market, and it did stagnate in a way. But in reality, what we actually saw when we look at the previous data that I pulled up from Land Registry through the period of the Brexit, we actually saw prices increase. So although the property market did stagnate slightly and there was hesitance and confidence came out, prices actually did well and it actually performed very well. So if you look at it, that probably wasn't our mid-cycle dip. But when you look at what we're going through now and the prediction that yes, prices might drop slightly, but a lot of the predictions we're having from such places such as Knight Frank, for example, they're actually indicating that it's going to be a quick rebound, which again would be in line with a mid-cycle dip here, because after a slight dip, you then have the rebound, and we have what we like to call the explosive phase, which is where prices rapidly increase. So around this area here is definitely a good time to buy, because even if you don't buy in the bottom of the dip and you buy just as it starts, you're still going to benefit from this increase here. So again, very interesting. You may take this in a different light or look at it differently. This is just how I perceive it and my thoughts. So what factors could assist the UK property market going forward? Well, first of all, finance rates are low. So the Bank of England, as you may well know, cut interest rates to a record low of 0.1%. Lending is cheap. Going forward, this will help the property market when lockdown is eased and it starts to restart again, because unlike the 2008-2009 crash, the financial crash, where when that happened, people couldn't actually borrow money, money is still able to be borrowed. So people can go out and still buy. So although you might have some people fall out of the market to buy because they might have lost their job or their income's been hit, what you will still have is finance there, so people can still go ahead and buy, so confidence will still be there. So this should help keep the property market going. And when we look at the mortgage market as a whole, you would have seen at the beginning of lockdown, almost 2/3 of most mortgage products were actually pulled from the market, which was very scary for a lot of people. And again, people perceive this as the property market being in trouble and the mortgage market being in trouble. However, when you look into it more, like we do, it was more a case of mortgage companies had to pull their products because, one, they didn't have the staff to deal with it, because staff were being pushed over to help with dealing with the mortgage holidays that were being sought after by the people, and also they couldn't physically do valuations because the lockdown. People couldn't get out and do the valuations. So again, they had to cut their loan to values, because at 60%, for example, they're more inclined just to do a desktop valuation because the risk to them on the lending side is a lot lower. So that's why that happened. Now we're seeing that things are settling, staff are sort of more accessible for them. They're actually, and as you can see, more products coming back to the market, loan to values are creeping up. So that is good news. So, quantitative easing. So the reason I'm going to talk about quantitative easing, because quantitative easing tends to lead to inflation. And how does this help the property market? So I'm not an economics expert, so I'm not going to go fully into this, but this is what I understand about quantitative easing, QE. So QE is a monetary policy where the central bank purchases longer term securities from the open market. So the reason they do this is to increase the money supply to the economy and encourage lending and investment. So it's to stimulate the economy. So it's often called printing money. So you probably would have heard the media or the newspapers talking about the government's printing money to help stimulate the economy. And they call it that because the newly created money is usually used to buy financial assets, other than government bonds. So when the extra money is brought into the system, it tends to naturally lead to inflation. And with inflation, that can help the property market. Now, when the government is obviously bringing all this extra money into the economy and quantitative easing is taking place, they are, of course, taking on debt. Now, when the government creates debt or takes on debt, it means they're more likely to encourage inflation going forward. Now, the reason they would encourage it is because when they take on a lot of debt to pay down that debt, they need to obviously stimulate the economy. That helps pay down their debt, but also another way that they can help reduce the debt a lot quicker is by inflation, because inflation devalues debt, and it also helps with with debt on such, say, a mortgage, for example. And this is because inflation devalues money, so that devalues your debt. So with inflation also comes asset price increases, so property prices could actually increase while inflation is taking place. So the reason I wanted to bring this up is because you can see that the government is pumping money into the economy to help stimulate, keep it going, and this would naturally lead to inflation, which then would potentially naturally lead to house price increases. Now, supply and demand. Supply and demand is a big factor in the property market. When we look at here, so this is the UK household projections. We see it follows from 2012 up until 2039. It's forever increasing, and we see the number of households is forecast to grow by 232,000 a year until 2033. Now, the UK is actually struggling to build more than 150,000 to 200,000 homes a year. So they're not keeping up with demand. They're actually not keeping up with the quota that the government introduced of supplying 240,000 additional homes per year. They've actually missed this target every year, which is compounding and compounding and compounding. So as the target has been missed and this is compounded, we're likely to see that supply and demand isn't going to change drastically, which will affect house prices because, of course, as demand is high and supply is lower, house prices should stay strong and potentially even increase. And going forward, once confidence comes back to the market and demand increases even more, then this could potentially be one of the catalysts for the sort of explosive phase of the property cycle. So, final thoughts. Let's quickly take a look at what could help stimulate the property market after lockdown. So what could be brought in to help the property market? So continuation of favourable lending terms, which we've had probably prior to the lockdown and for this to carry on going forward. So we want to see the mortgages, the lenders carry on with the favourable lending terms, carry on with those great rates and great products that we saw before lockdown. With this, it will really help keep the confidence in the market, keep the buyers there because they will be able to borrow, and this will really help the property market going forward. Now, we have seen this come back into the market, which is great. We've seen that mortgage lenders are bringing more of their products back, and when this happens and when it starts to really take off, they start competing again and more and better products come to the market. So fingers crossed, it should carry on and this will help the property market going forward. What else? So the industry actually adapting and innovating how to sell property, especially while social distancing measures are in place, because although lockdown might be eased, it's no doubt that social distancing measures will still be there. So estate agents, for example, need to definitely have ways to still sell, which we are seeing. We're seeing virtual viewings. Obviously, paperwork can now be signed electronically. So there's a lot that is going on, and I believe it will carry on actually going forward. I think the way property is sold is definitely going to change slightly following on from the coronavirus, because the industry has been forced to, and it's actually been quite positive, some of the changes. So I would see them carrying on. We need that government support that we've been receiving so far, the unprecedented government support that we've seen, which has been phenomenal. We need that to carry on for people and businesses, as this will help assist with a quick recovery. So with the quick recovery of the economy, obviously helps the property market as well. And also we need to look at the government incentives going forward. So this could help sort of help stimulate the property market after lockdown. There's talks of a stamp duty break or sort of incentive there as well, which would definitely help. This is something the property market's been crying out for anyway. Now definitely is a brilliant time for the government to introduce some sort of break or incentive for stamp duty to really help pick the property market back up, and it would definitely help bring investors back to the market. It would be a great stimulus for it. They're talking about extending the Help to Buy scheme. We saw the Help to Buy scheme really, again, impact the property market. It definitely increased demand. It helped more buyers, especially first-time buyers, come onto the market. And there's talks of them extending it, which is positive, which shows that the government is looking at ways to help really kick off the property market after lockdown. And also forbearance by lenders until sort of employment levels recover. We definitely need to see this, because there's a lot of people out there which will still struggle with their mortgages or payments or loans, wherever it may be. And we've had great positivity from lenders so far with their forbearance, which has definitely helped millions of people in the country. But we need to see this continue, because what we don't want is people getting in financial debt, and with that can come property repossessions if they can't keep up with mortgages, etc. So with mortgage repossessions, obviously that leads to forced sales. Forced sales then also puts downward pressure on prices, and it's not good for the property market. So if we can see forbearance continue, this will be great. My personal thoughts. As I've kind of mentioned before when talking about the 18-year property cycle, I'm predicting a slight dip in the property market. I don't think it'll be massive. I'm kind of in line with Knight Frank, where you're looking around a 3% dip and then a quick recovery. And as I said previously, I'm seeing this as a mid-cycle dip. Once this recovery takes place, I believe you will start to see the explosive phase, and demand will come back in, confidence will come back in, and the property market will really take off. Now, a question we get asked, is this a good time to buy? I personally think it is. When we look at what I'm saying with the property cycle predictions, yes. What I tend to find with a lot of people I speak to generally, and a few investors, with the current market conditions we find ourselves in and what they perceive the market as doing, they usually want to wait. And there's a number of reasons. One, they don't know what's going on, but two, the most common sort of response I get is, I want to wait for property prices to drop, then I will buy. From my point of view, I potentially see that as you are missing an opportunity. I can give an example. When Brexit first started to come to light and it started to affect the property market, when I was speaking to a few investors, they would say, I'm not going to buy now. Brexit's going to mean that property prices are going to drop. I'm going to wait for prices to drop, then I'm going to buy. So what may have happened with these people is they may have waited and waited and waited, and like we saw from the previous data, prices didn't actually drop due to Brexit. They actually increased 13%. So all that time, people were waiting. They were missing out on house price increases. So that just gives you an example there. That's it on this topic. Just want to leave you with one of my favorite quotes from Warren Buffett. So Warren Buffett said, simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful. Now, if we take this in context to what we're going through now, there is a lot of fear in the market. Now could be perceived as a good time to buy. There's not a lot of competition out there. If you wait to try and figure out what the bottom is, when you find the bottom, it then starts to creep up. And once you realize it's creeping up, that means demand is increasing, and then you have a lot more competition for trying to buy. That can lead you to panic buy, and it can mean you can sometimes overpay as well. So in a market that we're in where there's not much competition, sometimes it could be perceived as a better time to buy. So that's me done. I'm Toby from Track Capital. I'm one of the directors here. If you do want to go through any of this in more detail, want to discuss, I love discussing obviously property. It's a passion of mine, so I'm always free to talk, debate, get your views, your thoughts. It'd be great to hear. Feel free to go to our website, find us there, email us at info@trackcapital.co.uk or give us a call. Feel free online. You can also book a telephone consultation slot if you do want to talk through anything anymore. That's me. I'm Toby from Track Capital. I hope you're all well and hope you stay safe in these times, and hopefully speak to some of you soon. Take care.